Hey everyone. Today we're not doing a which stack is quieter video. We're talking about something that can change the entire mood of markets in 1 week. The Middle East conflict. Iran, the US, Israel, and spillover risk across the Gulf. And the real question for Singapore isn't just geopolitical. It's this. Does Singapore get a boost as a safe harbor? Or does uncertainty slow down our property market? Let's do this properly. No fear, no cheerleading. Just follow the money and the transmission channels. Because here's the mistake most people make. They focus on the explosions. The market focuses on the pipes. 3 pipes: energy, shipping, confidence. And when these 3 tighten at the same time, the world economy doesn't need to collapse to feel pain. It just needs to get more expensive, more cautious, and slower. Start with energy. When Iran is part of the equation, markets immediately price in disruption risk. And that's not theory. Reuters has been reporting major disruption to oil and gas operations and exports linked to this war dynamic. But the bigger story isn't just oil on a chart. The bigger story is what oil does to everything else. Because once energy risk rises, shipping becomes the next domino. And shipping is where inflation sneaks back in without looking dramatic. War risk insurance goes up, routes reroute, delivery timelines stretch, freight costs rise. And suddenly, the world pays more for the same goods. The Guardian has been reporting soaring shipping costs and heightened concern around protecting vessels near key choke points. Now stitch those two together, energy plus shipping, and you get the third pipe: confidence. Businesses hesitate. Consumers delay purchases. Investors demand a higher risk premium. And that's how a regional conflict becomes a global macro problem. Now, this is where it starts to matter for property. If energy and shipping push inflation higher, central banks become less eager to cut rates. Rate relief gets delayed or smaller or simply slower than people expect. Singapore commentary has flagged the inflation risk if oil and gas prices surge from this situation. So don't just watch the battlefield. Watch inflation expectations. Watch rate expectations. That's where property feels it. Now let's map the likely paths forward, because this conflict doesn't have just one outcome. There are 3 broad scenarios. Scenario 1. A short, sharp flare-up. Oil spikes, then cools. Shipping stabilizes. Markets breathe again. Scenario 2. Prolonged conflict. Not doomsday, but the war premium becomes normal. Costs stay elevated, confidence stays cautious, and inflation stays annoying. Scenario 3. The nasty one. Prolonged stress around shipping choke points and insurance costs. That's when you can get the worst mix. Inflation pressure stays alive while growth slows. That's the two-handed punch because it traps policymakers. Here's the twist for Singapore. Singapore can benefit most in Scenario 2 and feel uncertainty most in Scenario 3. And yes, both can happen at different times. So what about Singapore specifically? Singapore sits between 2 forces. Force 1 is safe haven demand. Force 2 is imported inflation risk. Let's talk about safe haven demand first, because Business Times article is basically saying this. Gulf wealth clients aren't panicking into a mass exit right now, but Singapore may see incremental inflows if conflict persists. That word incremental matters because it tells you what this really looks like in real life. It's not dramatic. It's not a stampede. It's a wealth manager getting more calls. It's a family office reviewing concentration risk. It's someone saying, keep my base in the region, but diversify a portion. And Singapore is a natural recipient of those marginal flows because the ecosystem is built for it. But here's the other side, and this is where people get too one-sided. Singapore is not immune. If energy stays elevated and shipping remains costly, Singapore imports inflation. That raises operating costs, squeezes households, and can soften confidence. Local reporting has pointed to this inflation risk channel. So now we come to the Singapore property market. And this is the most important point. The market won't move as one block. It splits into lanes. Lane 1 is the mass market, OCR and much of RCR, where affordability and financing matter most. If rates stay higher for longer, buyers become cautious. They don't necessarily disappear, but they slow down. And property markets usually cool in a very specific order. First, transactions slow. Then, negotiations widen. Only later do prices soften, and usually only when sellers have urgency. So if you're watching the next few months, don't stare at price headlines. Watch volume. Volume is your early warning system. Lane 2 is new launches versus resale. This is where many people misread the market. New launches are supply managed. Developers can pace releases, adjust their marketing mix, and hold price lines longer, especially if construction and logistics costs are rising. The result can be firm pricing but choppy sales momentum. Resale is different. Resale is human. Real-life timelines, schooling, upgrading, cashing out, downsizing. So resale tends to show negotiation space earlier, depending on seller urgency. Lane 3 is prime and luxury. This is where safe haven flows show up first, not across the whole island, but in segments that behave like capital preservation. So you can absolutely see a split market, prime supported while mass market slows, at the same time. And rentals? If relocations increase, executives, families, regional shifts, prime rentals can be supported, not because locals suddenly pay more, but because the tenant mix changes. Now let's close this with what I think is the most practical part of the entire video, the 4 indicators that tell you what's happening before the headlines settle. Indicator 1, energy and shipping stress. If shipping costs and energy costs stay elevated, inflation stays alive. Reuters has reported surging shipping and oil costs tied to this conflict dynamic. Indicator 2, inflation tone and rate expectations. If inflation risk rises, mortgage relief takes longer. Indicator 3, Singapore transaction volume. Volume moves first, prices follow later. Indicator 4, prime versus mass market divergent. If prime holds up while mass market slows, that's the signature of safe haven support plus financing friction. So here's the balanced conclusion. Yes, Singapore can benefit through incremental inflows if the conflict persists. But yes, Singapore can also face uncertainty through inflation and confidence channels that slow the broader market. And that's why the right question isn't, will property go up or down? The right question is, which lane are you in, and which lane is getting support or pressure? Tell me in the comments, are you a mass market buyer, new launch buyer, prime investor? Visit SingaporePropertyLens.com to uncover hidden pitfalls before you sell or buy your next home. My name is PK So, and I look forward to hearing from you. Stay safe.